today's meeting, decisions meeting. I'll declare the meeting open. Do we have any apologies? All the councillors are here. No apologies. Christina's kindly going to do the opening karakia for us. Welcome and thank you, Christina.
Karakia tata. Tū tawa mai I runga, tū tawa mai I raro, tū tawa mai I roto, tū tawa mai I waho. Kia tau ia te mauri tū, te mauri ora ki te katoa. Homi e, hui e.
Ai kia. Kia ora. Thank you, Christina. Do we have any urgent business or late items? No urgent business or late items. Any declarations of interest? No.
Not yet, I don't know.
Not yet.
Not yet, maybe on Thursday, but look at the agenda, Your Worship.
Right. Okay, well, we'll move on to item number 1 on our agendas, confirmation of the hearings minutes for Council's decision. Everybody had a read of them. Are they a true record?
Happy to move.
Happy to move. Councillor Graham. Seconder, please. Councillor Cotton. All those in favour, please say aye. Aye. Carried. Right, we'll move on to item number 2, the investment fund update, prepared by Greg. Welcome, Greg.
Thank you, Your Worship. Good morning, everybody. Yes, so with the investment surplus update, so as reported at the last Risk and Assurance Committee meeting, we had a gain of 1.07 million overall for the year. So that was an investment return achieved of 3.95%. So it was still a return, but it was under the budget of 4.10%. So yes, the table below just summarises we're showing that return of 1.07. And then when we take off the committed rates disbursement of 800k per year and the allocation to reserves is budgeted at 1.4 million, we actually have a distribution of a negative distribution. So it'll be rates disbursement will be coming out of equity. So just to also note though that we still have 857,000 of remaining surplus from the prior year that we can allocate to decisions. So and it's just an update on what happened with the investment fund in April. So we actually had a gain of 936k during April. So it's making a positive return again. And so the current fund balance is 29.17 million. So yeah, just take any discussion or questions.
Questions for Greg, please, councillors. Councillor McAtem.
Yeah, thank you, Your Worship. The interest on reserves is always a peculiar one because we don't actually hold those reserves.
Yeah, I think that's right. Steve and I had a discussion about that.
I may have asked a similar question last year.
Yeah, that's right.
In theory, we should have about $40 million in reserves if we're going to allocate it.
Yes, what we identified, Your Worship, was that when the rules were put in place, we were getting returns that were quite substantial. So the rate subsidy and the return on reserves, there was still discretionary money over and above that. And I said to Greg that what this highlights is that when you were below the budgeted return, I don't think there was ever any intention that we were going to have the rate subsidy and the reserve interest return required before we do anything else as well. So what we're highlighting is that we need to be looking at that for the long-term plan and relook at what the disbursement rules are as a consequence. So that's what we'll be looking at. Because you were correct, the book reflects the return against the reserve accounts, but the equity is a bit different.
Okay, I'll leave it till another discussion.
Yes, that's why we think it's something for the LTP to relook at those whole disbursement rules, the investment account, and just sort it out so that we it covers these sorts of occurrences in that, because we shouldn't have to be locked in completely in variable returns below budget to still return the whole amount to the reserve accounts. They should be reducing as well if the return is reducing. That's what we need to look at. But we only sort of looked at it and identified it when Greg was able to present it in the table form. You immediately look at it and go, I see a problem here. So we'll just take that through the LTP. The end result is that, which is clear, is that if you are going to make any decisions to use investment surplus or investment accounts, it'll just come out of equity. So even though we might have said that there was still money left over from the previous surplus, the end result is still going to have to come out of equity, even if you decided to use some of that. So the main point for your decision today, Thursday, is you can still make decisions to use investment surplus. It will just come out of equity when you do so.
Yeah.
So, Councillor Kettlewood, Councillor McKinney, you can.
Okay, yeah, I just wanted to, there probably needs to be quite a bit more discussion on that whole investments on that policy, because in some years, just taking the available funding from April to March, for some years, it was proven this year when Trump decided to bomb Iran, that basically means that there's no discretionary cash available. Share markets ping away in April. The money's still there. We've still got the equity in that account. But the thing I've probably seen already in my time on council is when you do have there is one of those good years, there's a tendency to splash that surplus out on all sorts of things, and some more worthy than others. And then you have a year like we've just had, and then there's a reluctance to potentially give money to some very good projects. So, yeah, we do need to have a good think about that disbursement.
And that'll be part of the one up and in the workshops to deal with. You're right in that sense, but also never also forget that it is doing what it was intended to do, which was to make funds available that was not rate funded decisions, right? Because otherwise community grants, funding and all this sort of thing would just be straight to the rates. And that's one thing we wanted to change, so that we had a fund that was funding a lot of those decisions. That's still there. It's not perfect as you've identified. We do need to make some changes, and the LTP is the appropriate time to do that.
So it's definitely noted for discussion on the LTP.
It is, isn't it, Greg?
Yes.
That's right.
Definitely, yeah.
Councillor Kettle.
Thank you, Worship. So then another way of looking at our starting point for today is, because we're going to because we didn't spend it all last year, we were prudent and left $857,000 in the pot, and then we want to take from the equity of $800,000 this year because we haven't got our targeted returns. Should we not start then realistically at is actually $57,137, because we can still go into our equity anyway, our decisions today. The starting point. Just the way it's written is saying that we've got 857 sitting there in the discretionary spend. You're taking $800,000 of equity, right? So realistically, really, if we're prudent, the starting point is 57. And if we go beyond that, it's okay. We could still take it from equity. I just see how it's written as, oh, you've got 857 to spend away, but we're going to take 800,000 of equity. So I'm yeah. So I think council should be looking at it. We've actually got $57,000 worth of discretionary spend to start.
No, through your worship. We don't have anything you take out would come out of equity, right? So between the reserve account interest balances that we put in place, the over $1 million of that, and taking out 800,000 for the rates subsidy, you've got more than what the return brought to us. So no matter what we do, it's coming out of equity. Anything you decide to do comes out of equity. That's the problem. The question that we have to resolve for the LTP and other bits and pieces is if you, on the one hand, said you're going to subsidise every year 800,000 rates, and then you get a variable return that's expected to be put back to reserve accounts. What do you do in a situation like this? What's really happened is that the books show that we've returned everything to the reserve accounts, and we've still got to fund 800,000 on top of that for the rate subsidy, and that's just going to come out of equity. So there's a question: is in that example, should we have returned all of the full amount to the reserve accounts, for example? But that's the way that we had been previously doing it, and that's what Greg has reflected. That's the issue: is there's been no change or reflection in terms of what's to be returned to the reserve accounts.
So
Just what's our true starting point then?
Our true starting point is that any decision you take to use investment funds for any item of discretion that you have will come out of equity of your investment account. That's the position.
So effectively, we've got a negative balance we're starting off with. Money's coming from
Of what figure?
So through you, your worship, the table on page 23, if you add the 800 to the 1.4 million, there's effectively 2.2 million we're saying we're taking out of it, and we had just over 1 million to apply to that. So that number at the bottom, which is Greg's got in green, is what's got to come out of equity to fund the 800 plus the interest to those reserve accounts.
So negative 1.2.
The 1.148, it's the line in green at the bottom. That's the net position.
So we're kicking off with the negative, but just for, Councillor McIntyre, Councillor Frost, Councillor Cotton, Councillor Harrison and Councillor Smith, you are aware of the $800,000 smoothing that's been applied over the years to smooth the rates. Do you want to give a brief history on that, just for the new councillors, Steve, on the $800,000 that the council decided to?
That's the history, your worship.
Yeah, but when did that start? How many years ago?
When we first set up the investment account. So we it was 2016 or 17, something like that. So when we sold the forestry and that we created the investment account and shifted it from pure bank accounts to an investment portfolio with a return process, and designed it so that it would be able to subsidise rates to a limited extent, but also be available for discretionary spend and project spend, only for projects.
So any return, the first 800,000 goes into help offsetting rates increases. So that's virtually the history. Councillor McIntyre, you had a question?
Yeah, well, when it comes to some of the motions for this in a few minutes, I'm still comfortable with making some of the equity available if we deem those projects to be very worthwhile. There's a lot of it's a confusing policy, but for me, it's the level of equity we've got in the investment fund and how that trends over the long term. And it's still been trending well, and it's still been trending upwards. And so, that's where I'll be tracking. Not to say it's going to be a lolly scramble, but if there are things here that are being worthwhile, then I want to have the chance to support them.
I think it'll be, Councillor Frost.
Through your worship. So just the 1.5 million that's committed to the Bruce community facilities, that will come out of equity as well when that is paid.
So 2.5.
Yeah.
It's
Well, it says 1.5 and
1.5.
investment update.
2.5.
Is that just a 1 year?
Would have been, to check.
It might just be
Might
1
have
year.
just been
This
1 year,
year's
yeah.
worth was budgeted. I'll have to double check that.
Check that.
Yeah, I thought, you know, it was 2.5.
It could be 1.5 this year and another one
It's
next
split
year.
between, yeah.
Might be between financial years, 2.5.
And just in terms of resolutions, Your Worship, I'm noting 1, 2 and 3. I don't actually think 4 is required because you're going to be doing, you'll be doing number 5, you're deferring decisions to the individual decision report. So my suggestion is you've got 1, 2, 3 and 5 to work with.
So, yeah, it's very unfortunate with the way the years panned out with the war offshore, which has really impacted on our investment fund. But even if the investment fund had been good, I think it would be all fair to agree that we're going to be faced with some challenges moving forward today with our decisions. And we'll just deal with them as we go. So, Councillor Cathwood.
Oh, if we're going to be moving on with 3, just how it's written, it notes the availability of 857 when you're coming from a starting position of negative 1.148 mil. Yeah, so long as everyone understands, to me, if you're being prudent, you've really got 857 when you're starting with a position of negative 1.14.
Your Worship, that's a good point. You know, on the basis of that plus the discussion, 3 is probably superfluous now anyway. So it's dropping down to 1, 2 and 5.
So do we need to actually change with that recommendation 3? Do we just don't have it?
Now that we understand that it's going to be equity regardless, we just
Yeah.
don't need that as a resolution.
Okay. Everybody happy with Councillor McAtamney?
No, I was going to move recommendations 1, 2 and 5.
So we have a recommendation from Councillor McAtamney, recommendations 1, 2 and 5. Seconder, Councillor Kennedy. All those in favour, please say aye. Aye. Against? Carried. Thank you. Thank you, Greg.
Still there.
Might as well hang around.
We need to resolve 3.
Stay poised. Right, item number 3. Well, the floor is yours, Greg.
Yeah, thank you, Worship. Yeah, so the carry forwards, so they're all summarised on page 27. So we went through with the all the teams that had the capital projects and just worked out what they had spent year to date in terms of the budget, what they projected to spend for April, May to June. The year to date was to March. And then worked out from there what was to be carried forward into the next financial year. So we have included those in the baseline already. Just also, the report includes the rural water scheme budget adjustments as well, pages 28 to 29. Again, we have included those, updated those, but to note that those changes are in the 26-27 year, so there'll be no rates impact in those till 27-28, at which point the Three Waters will be under the new CCO. So I've just noted that under the under each recommendation there as well. So, but yeah, happy to take any discussion or questions on that.
Questions for Greg, please, councillors. Councillor McAtamney.
Yep, thank you, Your Worship. If I can just ask one, some of those ones with the investment surplus, some of those projects have actually been completed, but obviously the funds have been drawn from somewhere else. I just noticed that one with it's a small one, the Club boat ramp improvements. That was done well over a year ago, the $10,000 budget, but yet supposedly it's still getting carried forward. So it just, to me, I thought, well, actually, there's several others with investment surplus there, and some of those probably also. So that money obviously hasn't been,
Through
it's
your
been
worship.
paid for somewhere.
Yeah, it was part of the carry forward request, so I think Mike's going to.
I can speak to that one directly if you like, Your Worship. So in that particular case, I think what's happened there is you're right, that project's been completed, but the council funding that went towards that particular project has been drawn from the other pot of money that for Luther Valley Our Place projects. So it's just been taken from the wrong code. That's all. Yeah.
So, okay, so there's several others, there's probably another 15 or 20 others there. None of them will fit into that category either.
I'm not sure, possibly, but I'm aware of that one. I haven't spotted any others like that, but yeah, that's just what's happened there. It's not that the money hasn't been spent. It was just there was two different pots, if you like, one for specifically for the boat ramp, one for the other projects, and it just went to the wrong one.
Councillors, any more questions for Greg? Please. Councillor Kennedy.
Greg, the Gabriel Gully entrance, that was last year, there was 50,000, so it obviously hasn't been picked up, it's still sitting, waiting.
Yes, that's right. It's been a request to carry that forward, so
Right.
Mike's going to say something.
So it hasn't been used yet?
No, not yet, no. So that's, yes, we carry forward to next financial year to be used in that period, so.
And it is included in the decision paper.
Yeah.
On the community funding request.
Councillor Cathwood.
So just on that note, that you picked up on the investment surplus. So those figures there, would they come off the 857 as your starting point of unspent, or is that saying that they've spent?
These ones they're already come out of it because they were already committed to it in the previous years.
Okay.
So anything that's like carry
But
forward
they're obviously
prior year has already come out of it.
They're obviously still sitting in the fund currently.
Yeah, that's right.
As part of
they're
the
spent. So yes, pretty much each year I'll have to do like a reconciliation of what we've actually spent from what we've committed from the investment surplus to withdraw that amount. So yeah.
So what's the actual figure of the investment fund minus committed? What's the actual true?
You have to calculate.
Yeah, I'll have to look it up.
No, not now. But
Yeah, no, that's something I can.
That's something that we should know
Yeah.
all the time, because I mean, we've committed to Milton 2.5, so we know that that's going to come out. So what's the actual true figure of what's sitting in that fund?
Yeah, no, that's something I can work out. Yep.
Councillor McAtemi.
Thank you, Your Worship. So just on that note, with some of those carry forwards and investment surpluses, I think we need more than just the one capital account or the one investment account. That's for a discussion for the long-term plan. But we need, to simplify things and make it simpler or more than one fund, so that money could be withdrawn, placed in a fund ready to be moved.
Yeah, so separate. Yep.
We have made a change that we are holding cash that we receive that would otherwise go into the investment fund to be used for drawdowns instead of breaking the investment fund for questions. So in the past, we used to have issues that we forgot to actually draw it down in a particular year and things like that. That was cause us a problem. But we do put money into investment when we sell property and things like that. So we've been being a bit smarter about that and holding that in interest-bearing accounts to be used to be drawn down for some of these commitments. Right? So we didn't have to break our investment account. It's still all part of the investment total, but it's sitting in more than one account.
Question, Greg, the Weka Reservoir upgrade with the one big Tasman steel tank, but we didn't go that way, did we? With individual tanks.
I would have to ask somebody from the capital team.
Councillor Cathwood, is that not the case?
You're correct. It's 30,000 litre tanks.
Raymond's gonna.
Through your worship. For Owaka, it's still the small tanks, not a steel tank.
And not a steel tank?
Yeah.
Yeah.
It's just the titles from the previous LTP.
Change the point.
The figures are the same now, aren't they? 249, aren't they?
Yeah,
Total.
apart from the description, the figures are the same?
You would
Budget.
expect, shouldn't it?
Yeah.
Should be cheaper.
It had already been readjusted to the revised figure through you, your worship.
Through your worship, we didn't change any of those budgets from the original one, so it should be the same.
249.
Well, if we don't have any more questions for Greg, would someone like to move any of these recommendations?
It could all be taken as your worship with approves as opposed to does not, could I suggest?
What are you proposing there, Councillor Graham?
Need to move it.
Move all?
Get the jump the gun on to the next one.
Just ease into it, please, Councillor Graham. It's going to be a long
Sorry?
day. Just ease into it. It's going to be a long day.
Best take time to do it properly though, are we not?
Yes.
One, approve for 2. 3, approve. 4, 4 approve. Yeah, and 5 and 6 approve them.
Happy to second.
So moved by Councillor Graham, seconded by Councillor Cotton. All those in favour?
Aye.
Against? Carried.
Thank you, your worship.
Thank you, Greg. Right, agenda item number 4, the rates baseline update. Welcome, Sharon.
Thank you, Your Worship. So this report is reflecting the change in the rates from consultation till now with the carry forwards that Greg just mentioned processed through. And so that brought the percentage down from 20.58 to 19.02. And I think just to note, as you're going through your decision making, for every 220,000 you add back in, it's 0.5%. So if you added in 220 now, it would take you to 19.5. Just so you've got that in your mind. And the other thing I wanted to mention before I take any questions is Andrew Mickle from the Local Government Funding Authority is going to pop along. I've just emailed him to join us. He wants to pop along and talk to you. They have been with all the legislation that's hitting us around water and rates capping and things like that. They've been reviewing long-term plans and annual plans, and they just want to talk through the things they've been coming up against and how they see stuff for us, and things they want us to work on and look at stuff. So hopefully he'll jump into the meeting very soon to talk to you. And I've put they had a meeting and discussed all the council's different positions, and I've put his comments on the bottom for you to read, and that's what he's going to talk to. Other than that, happy to take any questions.
Right, I'm sure you've got lots of questions for Sharon, councillors. Questions, please. Councillor Graham.
What was that figure again for the 0.5%?
220, I believe. Greg, can you just double check that for me, please? It was 220, wasn't it?
490 was 1%.
It's 220.
It's 49 million. Right? I have. It's 490.
Right.
200.
Oh.
It's 0.48%.
Agreed. Sorry, through you, Your Worship.
Page.
On page 35 at the bottom, it says our total rates requirement is 49 million and change. So is 1% of that not 490,000?
Yeah. And half of that is 247.
245.
That's half a page.
Okay. I thought we were working 490 the whole way through. That's all. If it's 200, that's much better.
Really?
That is it. It's a lot better. That's 20% more.
Questions, please, councillor Sharon. Councillor Frost.
Thank you. Could you just explain, Karen, you've got this little 30% capped rate,
Rates cap.
30% capped rate, yep, on page 33 is 23.45%, and the bigger figure is 19.02%. Can you explain why there's a difference?
Yep, through you, Worship, there's certain legislation within the Rating Act that says certain rates can't be above 30% of the total rates take. And that's all our fixed charges like our UAGC, our footpath rates, our local roading fixed charge. So we have to calculate, we look at our total rates take and we add all those up and they can't be more than 30% of that total.
Yep. And
so the 19.02 is what our rates increases from last year, but the 30% is how much of those rates that by legislation can't be above 30. And that excludes water. That's very confusing, isn't it? So of our total rates, there's only certain types of rates that can't be included in that 30%, can't be above 30%. So you have to have some based on land value, capital value, things like that. You couldn't have just one fixed charge for the whole district.
We're used to presenting this every year the same way, councillor, and sometimes, we need to explain to new elected members how those things work. And it can be confusing because, the self-imposed rates cap is a different figure again, that's 20%, right? And the rates increase relates to that rates cap. The 30% cap relates to a totally different thing.
Through you, Richard, I can send you through that calculation and how it's made up and the bits out of, would that be interesting for everybody? Yeah, I can do that. Perfect.
But just rest assured that 23.45 has nothing to do with the 19.
No, thank you. It's just making sure that we don't break the law of how we're allowed to set the rates.
Through you, Worship, if you look back at the LTP 24-34, 24-25, we were right up against that cap. We're at 29%. So we had to stay below that, and that was discussed at a previous meeting about how we introduced a different rating method for some of our public toilet money. So we had to do that to stay under the 30% cap.
Andrew.
We do have Andrew online.
Welcome, Andrew.
Welcome, Andrew. Can you hear us?
Good morning. Yep, no, I can hear you well.
Okay, so I've just explained to the council, Andrew, that you'd like to pop along and talk about the sort of what you've been looking at for all the councils across the district because of the new legislations and where everything's sitting and stuff. So, and I've given them your email that I forwarded to you the other day and said I'd pop that in for them to look at and just said that you'd like to talk to them about that. So the floor is yours.
Yep, thank you and good morning, everyone. So I'll just do a bit of a brief overview and then happy maybe to take questions might be the best way to do it. But more than happy to come down and speak to the councillors in greater depth as you go through your LTP workshops, if that would be of assistance. So I suppose LGFA has two hats. I mean, our first one is we were established to provide financing to councils, cheaper financing, certainty of financing, And we want to do everything we can to be supportive of the sector because we're owned by councils and that's the reason we exist. So quite different from banks that maybe would take a more commercial decision in regard to lending. But on the other hand, the other hat we wear is we have 74 councils that guarantee LGFA. So we also have responsibility to those councils to be prudent with our lending decisions. And if we were not prudent, they would quite rightly turn around and criticise us and saying, well, you know, given the financial state, why did you keep lending? So that's the other obligation we do. So my role at LGFA is to oversee council's finances. So that's what I pretty much spend every day doing. And I report to our CEO and also to the LGFA board on those outcomes and raise any sort of concerns with them. So at our last LGFA meeting, the board did discuss Clutha's financial position. One thing that changes the landscape significantly for us is rates capping legislation. So we've been doing a little bit of work with DA on that, but again, like yourselves, legislation hasn't been passed. We don't see the exact details on that yet. However, in the past, I think the LGFA board, if a council has an unbalanced budget position, has been more open to allow a council to transition over time. So, if you get an increase in depreciation charge, phasing that recovery and depreciation over a number of years politically is easier in terms of the way the impact on rates to the community. But once rates capping comes in, that budgetary flexibility gets taken away for councils. And so it's really important when we get to July 2029 that councils have a balanced budget operating position. So even at that point, it's going to be hard enough with rates capping coming in. But if you're running an unbalanced budget, then that's just going to be unsustainable because the only lever you really end up with is cutting levels of service. So the sector as a whole has a balanced budget outcome. It averaged in 24-25, it averaged 100.2%. So on average, councils are balancing their budget. But there were 10 councils that had an outcome of less than 90%, and Clutha at 62%. Since the benchmark was introduced in 2012, that's unprecedented to see a budget deficit of that size, and hence our concerns. In terms of your financial covenant outcomes, as at June 2025, it was 207%. So that is getting really high for a rural council. But if I work out the impact of what you've borrowed for operating purposes, only looking at the last 4 years, had you not done that, then your debt to revenue would have been 106%, not 207%. So you've borrowed around 55 million for operating purposes alone, and that's clearly not sustainable and needs to change. So I'll stop there and happy to take any questions.
Councillors. Councillor McAtena, I see you're working on one.
Yeah, I can't argue with that number. Andrew, the one thing I will note with our district's debt is that I've never actually seen the number, but a large chunk of it is debt funded through rural water schemes. So a lot of that debt is funded as a business expense by the farmers, not as a household. So it's not paid for by the households. I'll be guessing we'd have $50 to $60 million of that debt belongs to rural water, which is So I know it has to fall under the covenants, but that money is a lot of that debt funding is pretty well locked in by those businesses.
Yeah, I mean, that may be the case, and we could start to break things down at individual level. But you've only got to look at your financial covenant outcomes. And June 21, you had minus 34% net debt to revenue. So you had more financial assets than debt. That's only 4 financial years ago.
Yeah.
Now it's gone to 207%. I mean, in all my time, I haven't seen a council's debt levels deteriorate as fast as what yours have been. We can't go back and revisit decisions that have been made in the past, so we can only look forward. But yeah, the size of your budget deficit is unprecedented. The rise in your debt levels, while some of it may be being used for infrastructure purposes, which is good, a lot of it hasn't been. It is simply that your rates has been insufficient in the past. And, you know, just looking at your annual plan, I mean, to balance your budget, and I know there's more than one way to balance the budget other than just increasing rates. So LDFA is not saying you need to increase rates. We're saying you need to have a financial strategy that is prudent. But you need something in the order of 50% rate increase to balance your budget this year. So that's just the reality. I mean, we're only comparing you to everyone else. So,
just through you, Worship, just a question though, which we have discussed, is that in comparing us to everyone else, you know, a large chunk of that is roading valuation movements, and everybody else has roading valuation movements too. So, and they don't fully depreciate those. And I know that we had the largest movement of valuation, correct. But, you know, when you're comparing us to others in that sense, it's not like if you're suggesting that we need to, you know, fully fund that, the other councils aren't looking at fully funding that either.
okay, so depreciation is an interesting concept, and we've gone back and looked at, you know, we have all the data on council's depreciation throughout the last, 15 years, and just taking a snapshot over the last 5 years, there is huge divergence within the sector about changes in depreciation sort of costs, but you're not alone in having your depreciation costs increased by more than 100% over the last 5 years. So there are other councils that have that same issue. So yes, it's true that you get a funding assistant rate, which is relatively high with NZTA, but you're still left with the gap between the FAR and what it costs to replace a road. So it is a strategic decision, an issue that you're going to have to discuss with the NZTA, the level of funding in the future. But also, if roads are going to cost more to replace, then somehow that needs to be funded. So the council is going to have to fund the difference between the FAR and what it costs to build the road, or else you have to look at levels of service. But again, you're not alone in a council that has a large roading network. There are, not every council has that, but there are other councils in that exact same position. And when rates capping comes in, you're simply going to have to fund that sort of difference. Otherwise, you won't be able to replace your roads over the long term.
Andrew, again, I probably need to see a few more of these numbers. So we're looking at taking a total, council is expecting a total revenue this year of about 75 million, I think that's correct. So you're saying that what's your expected operating deficit?
Well, if you look at your last 2 financial years, if you look at the cash flow statement, you had a cash flow deficit. So your operating expenses were higher than your cash operating income. So regardless of the change in roading depreciation, you weren't funding a single dollar of depreciation in terms of your cash flows. I mean, again, when you compare every other council, I don't know a single other council that was in that position. So your deficit in the 2026-27 annual plan, I think I worked out your balance budget was something like 82%. So again, your income is roughly 82% of your expenses. So you've got that 18% gap. Now, I know we could debate about the exact methodology, and there may be some infrastructure that you don't need to fund depreciation on, like, you know, a swimming pool, for example, if the community's going to raise all the money to replace it. So we could debate the exact methodology, but, you know, in broad back of the number things, yeah, as I said, rather than the 20% rate increase that you're proposing, you need something like 50% to do it. And I know Waitaki's having the same debate, and although their debt levels are nowhere near as high as yours, so they have a lot more headroom. But it's the same issue, that the income just isn't sufficient to cater for the expenses.
That's the expenses, including that full depreciation, though, because we're not looking at we're not actually looking at forking out 90-something million in cash flow expenses.
Yeah, depreciation is a concept that you need to think about over time. So, you know, if we look at the roads, the fact that your roads are now revalued higher, so I can't tell whether that valuation was fair or not. I could quite rightly go back and question that, because it's really critical to your strategy that you know what the valuation is. But the fact that you've got that movement, if you think about it, what it's telling you is it's going to cost a lot more to replace roads than what it has in the past. So if NZTA isn't going to give you any more money, where's the additional money coming from to replace the roads?
Yep, thank you.
It's not a perfect concept, depreciation. It is an approximate, if you fund your depreciation over the life of the asset, it is broadly telling you you will accumulate enough cash to be able to replace that asset. Of course, some things have a life of 80 years, and what we end up replacing is very different than what the original project is. But you could also fund, rather than fund depreciation, you could fund the debt, but that's going to be problematic when rates capping come in. That approach won't work anywhere near as well as depreciation. So it's not a perfect concept. It's broadly a concept that will work over time to enable you to do your renewals.
Councillor Cathwood.
Well, I suppose it's not actually a question for Andrew, but you're saying we should be increasing 50%, not 20%. That's what I'm hearing. So I'm not asking for a reply from Andrew, I'm asking for a reply from Sharon.
No, I mean, the answer, through your worship, is that LGFA has provided us a response.
Yeah.
And it's not looking for change in this particular annual plan from what we've consulted. They have given some preconditions for work which they expect us to do through the LTP. And there's a range of things we need to be working on. We've said that. So the objective is to cut the deficits so that we end up losing. We don't create deficits. So the annual plan is designed to do that. Putting aside depreciation, we're working on what that's going to mean, but we need to focus on ensuring that we don't have any operating deficits. So we've cut that back this year in actual terms, and the budget should be reflecting that terms of going forward, the changes were made there. That's why the rates are still up there in terms of what's being asked for. We've re-looked at the valuations. There's been some changes associated with that, so that's a positive. There has been a positive change in the revaluation, quite a substantial change. Dropped from something like, was it 19 million down to 13 million?
Oh, well, 16 with the initial review, and then potentially if we look at a different way of, if we look at 150 years worth of future renewals, the initial analysis suggests that it'll be $13 million a year, but that we flagged that and discussed that with NZTA and said we need to do more work on that and work that through with the LTP as well. So that work's already started as well.
So basically we're looking to the LTP to give satisfaction and comfort to LGFA. So we need to work our way through that. I think the message was we didn't want any radical changes to this budget downwards in terms of what's being proposed. And what has been coming through in consultation and what we've done doesn't suggest that we're going to make any radical downward changes in what's going up for for consultation. We have a cap, don't forget, of 20%. That's the LTP cap as well. So we are going out just below the cap, depending on your decisions. And then we're working with LGFA. They've been very helpful. They've listed the areas that we need to be looking at, and they haven't linked that to this particular annual plan. In that sense, they're looking for us to find resolutions moving into the LTP, which is what you'd expect us to do anyway.
I should add that we know, water will go out that next year, and your water operations are currently running at a loss, and so removing them will help the council's financial performance. However, that's going to be offset to some extent by the impact of stranded overheads. So again, we've modelled all of that to get an idea what that will look like, but we're guessing a bit when we look at the impact of stranded overheads just based on what the council's. So I think the LTP, the draft LTP, is like really crucial having that information. So what we're asking, I think the annual plan is a step in the right direction. We know it's, affordability is a huge issue, and it's a painful decision. But even after doing that, you're still left with a significant operating deficit, which really needs to be addressed when you do your draft LTP. But perhaps removing water will at the margin sort of help with that decision. The other thing I should add is we've looked at other jurisdictions, but when you look at New South Wales, which the government is focused on a lot, you can see the impact on rates capping. So when we look at Central Coast Council is the one that gets talked about a lot, but that's a council nearly as big as Christchurch in terms of population, so located in Gosford. That had 4 years of operating deficits before it was put into administration. And the deficits, in a relative sense, were not as big as the ones you've had over the last 4 years. So once rates capping comes in and that financial flexibility is removed, it really changes, the landscape from a lender's perspective. So I think next year is a real crucial year for you in terms of working on your financial strategy, but you still have the opportunity to do that.
Andrew, it's Jock here. With the recent government announcement at our Rural and Provincial Mayoral Forum last week, there was talk with the ministers to, are they actually aware of the impact that their announcement's going to have on our long-term plans? Because what's the point of actually doing a long-term plan when you're going to be dissolved in 2028? So the question back to the ministers was, do we just roll over and do one more annual plan? So, we've got all these balls in the air too. So what's your opinion on that when you start with the line of talk you're using?
Yeah, the LGFA board has views on things like sort of rates capping. In terms of that, but again, like yourselves, I mean, we can only sort of work with whatever policy the government today chooses to implement. But it makes it incredibly hard for both councils and ourselves trying to monitor or try to work out the financial strategies for councils when there's just so much uncertainty that exists. So, yeah.
Oh, well,
We just have to work with whatever the government does. So, yeah.
it's encouraging to know that we haven't got it on our own then. Yeah.
Oh, I take your point though that you've raised. Yeah.
Just Andrew, yes, Simon here again. Just following on from that, those stranded overheads, they're going to have a massive impact on this council. But we can spend a lot of time with them, and then in a year's time, someone else might be deciding it for us. So that's potentially a lot of work for to go nowhere.
Yeah, but having good data on that's really important to you when you do your LTP workshops. So, good information will help you make good decisions, even though they won't be easy.
I think councillors, Andrew's sort of touching on the underinvestment of years gone by with rates capping set at 3%. How many years did that go on? 4 years.
No, 4%.
4%.
He came in when I got here, which was 2015.
2015, so 11 years. Now it's we're facing the reality of it here. Now, today. Any further questions for Andrew? Sharon, got any questions?
I'm good. Thank you, Andrew.
Yeah, thanks so much for your input, Andrew.
Okay, thank you. I'm more than happy to come down and speak to you in more detail if that would help.
I think that might be the case in the very near future.
Okay, just ask. We want to help you as much as possible.
Perfect.
Well, there you go. We've had it from the horse's mouth. Right, any more questions for Sharon? Councillor Cotton.
Sorry. Thank you, Your Worship. Sharon, just on the Three Waters depreciation at 25%, so that's just an average, is it, or?
Through you, Your Worship, we get a valuation done that has the depreciation for each water scheme, by each scheme, and so we fund 25% of that for each one.
For each one?
Yeah. And for urban.
Yeah. So it's not higher for some and lower for others?
It was a council decision to leave it at that level.
Yeah. Thank you.
Councillor Catherwood.
Probably more of a comment, but at the end of the day, I suppose it's the way the ball that's in front of us today is in your plan, but crikey, when that talk we've just had from Andrew, she was up your spine, but we as councillors, I suppose we've got amalgamation getting talked around us. We've got rates capping coming ahead of us. We just had that talk about our LGFA. It comes along with the figure of should have an increase of 50%. Flying operating costs. I mean, crikey, what a tough task our staff have got ahead of them. And decisions for us to make around this table. So I don't know where I'm going with this, but crikey, local government needs a bit better direction from those that are putting this pressure on our staff and ourselves is the comment I want to make, because it actually scares me when I hear that. We should have gone for 50. We should be facing a 50% increase. And we're going to make decisions to go under our cap of 20. So everyone in this room should be very, very concerned about that. But here we are with amalgamation going on us. rates capping, the LGFA funding, outside of operating budgets. Yeah, I think we should be inviting Andrew to turn up as soon as possible. And then where do we head? Like, is it pointless doing a long-term plan? Gosh, those comments have scared me.
Yeah, certainly take all that on board, Councillor Catherwood. We're well aware of that. That's worrying about that's not going to get today's decisions out of the road. And yes, it does create a bit of a lump in the throat, not in the guts, but we've heard it from the horse's mouth. This is what we're dealing with. We know what's coming at us like a freight train. So I think from now we focus on the task at hand with that in the back of mind on today's decisions. So
Yes, Your Worship. I mean, just so it's not a complete doom and gloom side of things. If you have to realise that a substantial part of the issue is the unfunded depreciation, and it's both in Three Waters and it's in the roading, right? So Three Waters, we lose Three Waters in 2027. So July 27th, the Three Waters goes across, including the issue of the operational expenditure, which we are getting down and down. We should be budgeting to be nearly okay. We know the issue is on non-routine expenditure, so we know they're going to carry a bit of a deficit there still potentially. But we've done a lot of work to try and really drop down that operating deficit. The underfunded depreciation in Three Waters is still there. Those were part of the decisions when we were going to transfer Three Waters earlier, and it's still part of the decision in transferring Three Waters. But that problem is still an issue because, you know, it's the CCO's got it, right, in that sense, and it's still feeding the district, but it's not the council's balance sheet problem with LGFA. So that will be resolved. And then you've got the roading revaluation, depreciation issue, and that's not, there's no way I can see that we would ever fully fund roading depreciation. That's just not going to happen. And there's answers to that. We'll work with NZTA, we'll get NZTA and ourselves and LGFA together so that there's a resolution to that side of things, so that there's an acceptable and affordable approach and answer to that side of funding roading, the roading asset, and that side of things. So those things, which are a big part of the problem we've got, will be, you know, substantially resolved as we work our way through. And then what we need to be focusing is on making sure we don't have any other operational deficits. Really important. So the work that Donna and team are working on to ensure that we're not creating deficits in the waste activity, which has been generating it every year. We're going to resolve that. We're doing things now, and we'll have fixed that in the budget. So that's another problem on in terms of that, right? So, you know, I just want to. There is a risk, so we don't want to discount the risk, right? The numbers are big and all that side of it, but there are things happening that will substantially address the issues that he's raising. We have something we've got to monitor and watch is that 4% cap, what that means. But we have you know, there's options associated with that too. So I just want to say that just remember that there are things happening, and there are resolutions coming through that are going to be applied.
And then my comment to that then, Steve, would be that we just have to then also remember that it's all very well saying the water's going to the site. It's the same people going to be paying for it to a different company. So it doesn't go away.
Through you, Your Worship, I don't think all the information from DIA is that the new water entities are not going to fund depreciation like we do. They're going to look to fund long-term renewal programs. So it's a different funding model and a different way of operating, looking at longer loans, other things like that. So they're looking at different ways of doing things, and that's based on feedback from other large water entities around that they've looked at in other parts of the world. So it's not exactly, they're not going to run it like we did. They're going to run it in a different way, and they'll be running under a different set of rules. So the Commerce Commission will be overseeing them as a financial regulatory authority. So it doesn't mean they're just going to be funding depreciation automatically. It's going to be looking at different ways of doing it.
I doubt that anyone will be paying any less for that same service.
that.
Just to add to the concerns highlighted there, Councillor Catherwood, it was identified 2 years ago that we were looking down the barrel at 45%. And please remember the decisions were made to smooth that with the 11 million. So 50%, 45%. I know they create a bit of a lump in the throat, but we have been aware of that. So. And it would be great, but like I say, if we hadn't had things locked in at 4% for 15 years, might not be in the situation that we're in today. So, Councillor.
Thank you, Your Worship. Probably as for all staff, I guess. So how much of this impact do you think central government policy has affected the position we're in? So what I mean by that is I know in rural water schemes under the previous government, the depreciation was given back to the consumer, and so there was funds aside that were being collected every year. And quite rightly so, the right decision was made at the time, but now that's sort of left us in a bit of a hole. So overall, has that been an issue, chasing government policy of the day?
Through Your Worship, I mean, we're basically the creature of government policy, so it depends how you want to categorise it. I mean, you take the water costs. That's all as a result of the policy changes that have occurred, right? So all the huge investments and all that. Now, some people will say it should be the case and it's all the right thing, but that was all from change in standards, change in requirements, all that side of things. That's a massive cost, and that side of it. There's all the regulatory ones as well, in terms of that side of things. So, yeah, but how do you define it? Just about everything that's occurred has been a cost requirement imposed by government.
So what Jules was talking about, how Commerce Commission is going to be overseeing these CCOs and all that sort of thing, longer term loans and not funding depreciation the way we're used to. I suppose that is one of the ways central government is trying to attack the affordability of these services.
Potentially. We've, other than discussions, we're not privy to all of their thinking.
Well, that's yeah.
Well, that'll be one of the reasons why the CCO is going to be allowed to borrow up to 500% revenue, because that's where council sort of had to have gone in the long run. Yeah. And LGFA are actually they're prepared to do that. So yeah, we've been kicked off here a bit, and yet for pushing out to those levels to 280%, whereas from next year that CCO can stretch all the way to 500. It's just an inevitability about it.
Yeah, I think, Your Worship, is one of the big impacts of all of this is going to be affordability, and Andrew touched on that. And then where is that line drawn? Like affordability of water, affordability of services, affordability of roading, everything is impacted by that, isn't it? And I suspect that we're going to see DIA wading into this at some point.
I take on board Andrew's comments here. That's a pretty bold statement, saying 50%. Like I say, we've already identified 45%, but Andrew's not in the room here today to make the decisions that we're all about to make. He's put a lump in our throats moving forward for the remaining of the decisions making over the 2 days, but we're dealing with facts, and the facts are here in front of us. So I think he's made a very good point of getting it in front of our minds, but we need to move on and get on with our decisions. And like we went out for consultation at 20.58, we're down to 19.02. We're not too far off what was forecasted at 18.92 2 years ago. So we're there or thereabouts. So would anyone like to make any recommendations here to Sharon's report, or there's no further discussion?
Well, I can ask one question. So at 19%, from a cash flow 19% increase, from a cash flow point of view, if everything run to plan, would we break even cash flow?
No.
No.
No, so we've still got the risk in the water operations because of the non-routine expenditure. So we're expecting that to, we were talking about how much funding there is to play with and the historical actual spend. And we've come up with a figure, but we know it's below what the historical spend has been. So there is the risk of that area still having a cash deficit, right? I think we're intending to solve the waste one, so that's not creating a deficit from a cash turn. So other things I think are, like the salaries had been about balanced, so we haven't sort of spent those. Other key big things that I can think of in a cash sense. So I think there would be still that risk in there, which we've highlighted, that there'd be nothing like we've had in the past, but still the risk of a minor deficit.
Estimate monetary figure?
Well, the difference between, was it 250,000, something like that, potentially, historical difference between that and budgeted? Something along those lines.
I think non-routine's $500,000 in the budget. And that's something that's in the staff submissions as well to consider.
1.2%.
Yeah, but what's historical spend?
Oh, just over 5 million.
5.57 last year.
We've got 5 million in the budget.
So $500,000.
Yeah.
Okay. Sorry, not 250.
Yeah.
And we still don't run aware of our operating loss for this year.
Well, we've presented our first financial report.
Yeah, through you, Worship. That was only to February though, so the next one will be to April.
It's still being compound things, like the thinking council.
But it won't be compounded by was it $16 million? What was the difference?
The valuation for the road was around $20 million, up from about 10 million. So the increase in 1 year was $10 million of additional road appreciation. The initial work that Donna and Titus and the team have done have brought that, just reviewing the valuation as it was, that's now down to about $16 million. So the difference has now gone from $10 million to $6 million. And there's further work to be done because we don't think there's other different ways to look at it that have been proposed that will be done through the LTP and in discussion with NZTA. The initial look at that would potentially bring that initial $10 million difference down to $3 million. So that's some of those issues that LGFA have flagged. Those look like they're heading in the right direction. We have raised issues with NZTA and said, would you guys be prepared to spend an extra $10 million in our roading network each year in capital? And their unofficial response was, your roads and your network's in good condition. There's no way we think that needs that much more expenditure. So that's the process that Steve indicated we're working through, and we'll come back through the LTP. So I think we need to actually work through that process before we get Andrew down, because it can significantly change the playing field when we're looking at what we need to fund in the LTP.
Yeah. So that's if we go to an LTP.
So in the saying that, I found you're going from an extra 10 million potentially down to only 3 million. You're saying we're currently at 6 million?
No, it's the valuation that was signed off was the $10 million increase, and hence the concern from LGFA. But we're not locking any of that in. We're saying this is an indication of where it's heading, but we still need to do that work, do the work through the LTP, do the work with NZTA, and that will then end up what hits the LTP in terms of what we think we need to fund for our roading, and what case we think we need to make to NZTA as well in terms of expenditure.
So none of that expenditure you're talking about then is affecting this 19.02.
That's our existing budget. NZTA approved it 3 years ago. Was already budgeted in the LTP and the depreciation levels at that stage.
So then is that reflecting underinvestment in depreciation?
No, it reflects that during the LTP process, there was a change in our roading revaluation that had a massive uplift. And the work that the team's done has suggested we actually don't think it was as high as that. And also, when you think of it, when we get feedback about our network, we don't think there's lots and lots of roads that are about to fall apart, and we think there's a big bow wave of work in front of us. So we need to do the asset management work around that and bring that into our review the valuation, bring that into our AMP, have those discussions with NZTA, that investment logic mapping that we went through that session, and then that should inform the LTP and hopefully inform discussions with LGFA and say, this is where it looks like it's heading going forward, and this is our methodology. NZ, hopefully we can agree with the NZTA that they're comfortable with what we've done because they're a major funder for us, and that's part of that. We want to work through this process with the LTP, and hopefully we expect there will not be a $10 million difference between what we're doing in terms of the work and that increase in depreciation. That's what the information we have today that suggests will be that difference between what we're doing and what the book depreciation is, or how we choose to fund it, will significantly decrease.
Right, any further discussion? Councillor Frost.
So with the new software, whatever it's called, we're now running, is there any chance that we will be able to see what our operating expenses are if you take the water expense and income out and this issue around the roading? So that as a councillor, I can actually see whether or how much our expenses are outreaching our income. So I have a better idea of actually what we need to save or increase our income to end up in a balanced position.
That'll be done through the long-term plan.
So the next question is, when will that information be available then through the long-term plan? Because I mean, these are issues that need to be dealt with in the near future, not years down the track.
No, so we bring the financials together before Christmas for the LTP. So it's definitely being worked on up to there. We have to produce financials for that, and they're produced as a result of your decision and direction. And those would feature as workshop material between now and Christmas.
Thank you.
Councillor Cathal.
So then, we've identified, we're thinking that water operational 500,000 short in its operational budget. So what we've just...
Well, that's based on historical differences. Linda and her team are definitely reworking the contract in a different in a different structure to see what can be done to further reduce that risk. So they're definitely working on that.
But we're still highlighting, we're estimating 500.
Yeah,
so we're saying that 1%, 0.5% is 200, correct? So 500 is 1.25%, on top of 19.02. It's kind of realistic, isn't it?
Yeah, but I mean, we're talking about, when we're looking at the budgets for next year, where you've already determined what you're going to put to that, which is a decision when you decided that that's what you're going to put into it. And we couldn't afford to put any more when you were looking at the decisions to go out the 20.58 or whatever it is we went out with. That included a limited amount in terms of that non-routine expenditure. So, and we discussed that. So that's what we had available to us, because we just didn't have the freeboard to do more than that because the cap of 20%.
I'm just, I understand all that. I'm just saying, like, right now today, we're still saying that the 500,000 we're thinking is outside of operational budgets. And we're saying it's 200,000 for 0.5%. We've already agreed on that around this table today. We've identified 500,000. So what I'm saying is it's 1.2. You've got unbudgeted expenses of 1.2. It reflects the 1.25.
That's what Steve was highlighting earlier.
Which goes on top of the 19.02, because it's
if it happens, but we don't know because it hasn't happened.
Yes, I mean, if you I mean, like what I'd be suggesting, councillor, is that if through today's decisions, you make no decisions that have a rates impact, then one of the suggestions would be to put 0.75% of rates into that non-routine expenditure to reduce the deficit. Right? So that's always an option to you in terms of that. So that's what you just need to bear in mind as you work your way through. And you know, we gave you what you'd need, which is only a couple $100,000. It's not a lot to get you to 19.5. You need to be aware of that when you're making your decisions on discretionary spend and some of these requests that have a rates impact. And you've got a limited amount, you know, between 19.02 and 20%.
Right. Any further discussion? Well, if there's no further discussion, would someone like to move the recommendations outlined in our report? 1 and 2. Councillor Graham will move 1 and 2. Do we have a seconder? Councillor McCrosty. All those in favour, please say aye. Carried. Right, now our next paper, we are moving into public excluded, is that correct? So, Steve.
Yeah, what do you want to do about
reasons? Do you want to have a cup of tea before or after?
Yeah.
Before?
Yeah.
Oh, well, we'll go to public excluded first before we wait for a cuppa. So, Steve, reasons to move to public excluded. Does someone want to move that? Recommendation? Moved by Roger, seconded by Michelle. All those in favour, please say aye.
Aye.